Well, yesterday, the 13th, the market took a big hit, as did HBI. Although, well, I guess it's pretty much in line percentage-wise with the market in general. The nice thing about selling covered options is that I do better when the price of the underlying stock goes down because it means I can replace it cheaper. Remember, I'm not an investor. I'm a merchant. I create and sell stock option contracts. So I'm eager to be able to sell more and more of those because that increases the revenue stream. So when the price goes down, I'm able to cover more contracts. Conversely, if the price jumps rapidly and a lot, then that hurts me from the standpoint I can't sell as many contracts. So the revenue stream may suffer somewhat, but it continues. I mean, it's one thing to hold a stock and hope the price is going to go up or whatever, and so it goes up, a dollar, and you got 10,000 shares, you've made $10,000. Well, I can do that in 2 or 3 months. Just anyway, the I'm going to bring up the screen that I want to talk about. So let me do that. Okay. This is the landing page of my website, the link of which is in the description of this video. So I want to go to yesterday, which was the 13th, and look at specifically this page, this chart right here. As you can see, HBI dropped 65 cents a share, and I've got outstanding 14 $10 contracts, put contracts, and one I was able to sneak one $9 put contract in there with some of the premiums I received on the $10 contracts. But at any rate, as long as I can replace the 14 contracts, 1,400 shares, cheaper than the $10 that I paid for it, will pay for it. I'm good with that. It means I can do more contracts, which means more revenue. Okay, I'm creating this little video insert to go in the 913 video. And I want to touch on okay, when I'm all in cash, like I am now, all I'm able to do is write puts. And I'm not able, since I have no stock, I have no margin. So to trade option contracts or to sell them, certainly, you need a margin account. And the reason for this is if you don't have a margin account, the settlement takes 3 days. So you're basically losing a week's income. That's significant. But once you have an options account, rarely do you actually use it in terms of drawing upon it. But you do use it from the standpoint it allows you, if you have stock on hand that's unencumbered by covering a call, then you get half the market value of that stock available to you to sell put contracts. So sometimes I will not sell as many call contracts as I can cover so I can have some unencumbered stock to produce the margin to sell puts. Now, you might ask yourself, why in the world would I do that? Well, it's a number of reasons. Number one, the puts may be bringing a better premium than the calls. But more importantly is I have the possibility of creating a straddle. Now, with stocks, you cannot place an order to buy and sell the same stock. You can't have those orders active at the same time. It's against the exchange rules and against the law. So, I mean, if you tried to avoid that by placing a sell order with one broker and a buy order at another broker on the same stock, that's illegal. You'll go to jail for that. But with derivatives, stock options, while its value is based on an underlying stock, you're not buying or selling the stock. You're just selling the option for somebody to buy that or sell that stock at a certain price. So, at any rate, when you can create a straddle, and a straddle is defined as put and call contracts with the same strike price and the same expiration date, then you're betting both sides of the coin, which is great because you've cut down your risk and increased your revenue. Now, it's a little bit difficult to achieve. It doesn't happen that often, but it is something to consider. And as you get better at it, you'll see those opportunities to sacrifice the number of call contracts in order to put in play the put contracts. Like I said, there's really two reasons for doing that. If the premium on the put contract is higher than the call contract, or you simply want to create a straddle, that's when you would do that. Now, the margin allows you to cover those contracts, but you're not drawing on it, so you're not paying the interest. If at settlement, when the puts, let's take this example. If all your calls were not exercised, but just your puts, now you're loaded up with more stock. And at that point in time, you'd be using or drawing on your margin, and they would charge you the prevailing interest rate, which is getting higher and higher as the Fed increases the rate. But more often than not, that does not occur. And the tiny interest rate they're charging, as high as it is nothing compared to the premiums that you got by being able to draw on that margin. This subject is a little bit more complicated and certainly outside the scope of the video I'm going to insert this into. But I think it was appropriate to do this now and insert it in the video. I hope you agree. So it just depends on how fast this seesaw goes. It's definitely a seesaw, but the whole market's going down. We're going to see a recession. So we haven't seen the full impact of the rising interest rates on the market yet. The whole market over the past decade has really been propped up by cheap money. And as that cheap money disappears, people are not going to be as inclined to take risk. So it's going to hurt the riskier section. It will affect the riskier sectors first. So fortunately, HBI is in a good solid area. They manufacture underwear and other things, but these are things that people need. Now, people can go to cheaper stuff or more expensive stuff, but Hanes Brands meets that medium. It's a good value market or value product. So I'm confident they'll hang in there and not do as badly as the entire market. But anyway, the trend is in my favor right now. Whereas if you're an investor, it's not. But remember, I'm not an investor. I don't buy and hold stock, hoping the price will go up or collecting the dividend or whatever. Because with this, sometimes I can even happen to be the owner of record of some stock when the dividend is declared, and get a dividend too. I don't base my trades on that, but I luck out sometimes and do quite well with that. All right, so back to my most important message here is down in the green box down there. It says, it's not so much what I paid for it or what I sold it for, rather it's my replacement cost. Success is measured by how many contracts I can cover and the revenue it produces. So that's the thought for the day. Now, let me go on up to, okay, now today the market's not open yet, so this is all I've got here is the future chart. And this one was based on updated 0558 this morning. And it could change to anything by market open. So we may see the decline bottom out at least. I don't know. But anyway, we'll watch this and see how it goes. And I'll do a follow-up video on today, the 14th, at some point whenever it's appropriate. Appreciate your you viewing this, and hope you'll subscribe and hit the notifications button so that you can be notified when I post new videos. Have a good day.